Welcome to the Deep Dive. We're here to cut through the noise and get you well-informed, fast. Today, we are plunging into, well, a really dynamic sector, footwear and accessories. We've dug into the stock screener data for 3 key companies, and we're going to distill the important stuff for you.
Exactly. Our goal is to unpack it, all the basics, the technicals, what the news is saying, financial health, valuation, the whole picture for our top 3 picks.
Yeah.
And it's not just about the numbers themselves, right? It's about why they matter to you as someone trying to learn and what signals they might be sending.
Okay, so the 3 we've zoomed in on today, based on their market cap in the sector, are Deckers Outdoor Corp, that's ticker DECK, the big one, Nike Inc., ticker NKE.
Of course.
And the Swiss brand that's been making waves, On Holding AG, ticker ONON.
Right. Now, before we dive in, really important point here. This is all strictly for informational and, educational purposes.
Yeah.
We're using hypothetical examples, kind of like paper money math, just to illustrate things and make it a bit more engaging.
Definitely not financial advice.
Absolutely not. Always, always consult with a qualified professional before making any actual investment decisions. We're just here to spark some thinking.
Okay, disclaimer done. Let's get into it. First up, Deckers Outdoor Corporation, DCKA.
Yeah, Deckers. You probably know them best for UGG boots and increasingly those HOKA running shoes everyone seems to be wearing.
They're everywhere. So Deckers is U.S.-based, NYSE-listed, S&P 500 member. As of mid-September, market cap around $17.6 billion.
And looking at the recent performance, Deckers has made some pretty interesting moves. The stock screener shows it had a strong last quarter, up almost 17%.
16.93% to be exact, and the month before that also up over 14%.
Right, strong short-term momentum. But here's the thing, you zoom out.
Oh, the bigger picture.
Exactly, year over year, it's still down significantly, about 21.70%. So it's recovering, yeah, but from a deeper hole.
Okay, so a comeback story in progress, maybe. What about things like the RSI?
Good question. The relative strength index, the RSI 14, is sitting at 59.23. That's kind of neutral, maybe leaning slightly strong, but definitely not in that overbought zone yet.
Suggesting maybe there's still some room to run before it looks technically overheated?
Potentially, yeah. And technically, it's trading above its 20-day and 50-day moving averages. Those are generally seen as bullish short-term signals.
There's always a but, isn't there?
Well, yeah. It's still quite a bit below its 200-day simple moving average, down about 13.40%. That longer-term trend line is often a key indicator.
So short-term good, long-term trend still needs confirmation.
Kind of sums it up. And also, that current price, around $118.66, it's way off its 52-week high, like 47% down from over $220.
Wow, okay, that's a big gap. So let's do that paper money math, hypothetically speaking.
Yeah, let's play. Say you hypothetically put $10,000 into Deckers right at the start of this past quarter, catching that nearly 17% rise.
Yeah.
Your entry price would have been somewhere around $101.48 per share. So that 10 grand would have hypothetically bought you just under 100 shares, maybe 98 and a half shares.
Right. And today, at $118.66.
Those shares will be worth about $11,682. So that's a hypothetical paper profit of roughly $106.82. Not bad for a quarter.
Demonstrates that recent momentum nicely. Okay, flip side. Hypothetical sell trigger. Based just on these technicals.
It's tricky. It's not screaming sell based on being overbought, given the neutral RSI and being so far off the high. But maybe for a shorter term view, if it broke back down below that 20-day moving average pretty decisively, that might be a trigger for some.
Got it. Okay, beyond the charts, what's the news flow been like? What's the chatter?
Well, the sentiment seems pretty positive recently. You've got Zach's asking, is Deckers a buy now? Motley Fool even called it the ultimate growth stock to buy with $1,000.
Strong words.
Yeah, a lot of that seemed tied to their Q1 earnings beat back in July. Sales were up nearly 17%, really driven by HOKA and UGG doing well, especially overseas in Europe and China.
But it wasn't all smooth sailing with analysts.
No, mixed signals there. Some upgrades to strong buy earlier in the year, but also a cluster of downgrades back in May. And like others in this space, you see headlines popping up about potential tariff impacts. That's a recurring theme.
Okay, tariffs. We'll probably hear more about that. Let's look under the hood now, the financials. How healthy is Deckers fundamentally?
Oh, financially, they look quite strong based on the screener data. Profit margin is solid at 19.3%, gross margin even better at 56.28%. That shows they're efficient at making money from their sales.
And returns, ROA, ROE.
Really good. Return on assets, ROA, around 27.7%. Return on equity, ROE, is impressive at 43.58%. And return on invested capital, ROIC, is also strong at 36.46%. These suggest management is using assets and capital very effectively.
What about debt?
Very manageable, low debt to equity ratios, both short-term and long-term. Their current ratio is 2.94. Quick ratio 2.13 means they have plenty of liquid assets to cover short-term liabilities. It looks like a healthy balance sheet.
Okay, strong financials. How does the market value it? PE ratios, growth estimates.
The trailing price to earnings, the PE, is 18.22. The forward PE, looking ahead, is a little lower at 17.02, suggests analysts expect earnings to tick up a bit.
And growth, PEG ratio.
PEG ratio is 2.26. Growth-wise, EPS earnings per share projected to grow about 9.8% next year. The past 5 years saw really strong EPS growth, over 31%. Sales growth past 5 years, also solid at 18.5%. Consistent performance there.
Interesting. Last piece, ownership. Who holds the shares?
This is kind of striking. Institutional ownership is incredibly high, like 99.11%. Big funds love it.
Wow.
But insider ownership is quite low, only 1.80%. And there have been noted insider sales transactions recently, September, July, June.
Institutions piling in, insiders selling some. What do you make of that?
It's a point to consider, definitely. Could mean insiders are just diversifying or taking profits after the run-up, or it could signal they don't see massive upside from current levels. Hard to say for sure. But overall, Deckers looks financially strong, great trend momentum with HOKA especially. Just keep an eye on those insider sales and the potential tariff headwinds.
Okay, great breakdown of Deckers. Let's move to the giant in the room, Nike, NKE.
Yep, the Titan. Needs no introduction, really. U.S. company, Dow Jones member, S&P 500, massive market cap, $107.86 billion. Dwarfs the others we're looking at today.
Global operations, iconic brands like Converse too, just huge. How do its technicals look compared to Deckers?
It's a bit more of a mixed picture, actually. Recent weakness down slightly for the week and month as of mid-September.
Right.
But like Deckers, it had a strong quarter, up over 20%. Still, looking year-to-date and year-over-year, it's in the red.
So similar pattern, recent quarterly bounce, but still down longer term.
What about volatility in RSI? Volatility is actually lower than Deckers, which you might expect from a larger company. RSI is pretty neutral, right around 40.62, not near oversold or overbought, just neutral.
And how does that sit with the moving averages? You mentioned Deckers was below its 200-day.
Right. Nike's situation is slightly different there. It has dipped below its 20-day and 50-day averages recently, reflecting that short-term weakness, but it's still holding above its 200-day simple moving average by about 3.8%.
Okay, so the longer-term trend, technically, still looks positive despite the recent bumps.
That's often how it's interpreted, yes. Shows some underlying strength. Price-wise, it's at $73.03. That's nearly 40% above its 52-week low, so it's recovered substantially from the bottom, but still almost 20% below its 52-week high.
Still got ground to make up to reach the peak. Let's do the paper money math again. $10,000 start of the quarter, catching that 20.65% gain.
Okay, hypothetical $10. That quarterly gain means your entry price would have been around $60.53 per share.
So how many shares would that be?
Doing the math. Roughly 165 shares, give or take a fraction. And at today's $73.03.
Those 165 shares would be worth around $12,064. So a hypothetical paper profit of about $2,064. A bit more than Deckers over the same period, actually.
Interesting. And a hypothetical sell trigger for Nike.
Again, not at the high. RSI is neutral. But those recent dips below the 20 and 50-day averages, plus some mixed analyst views we'll get to. Maybe if it fails to reclaim those levels or drops decisively below the 50-day, some short-term traders might see that as a signal.
Makes sense. So what is the news flow around Nike? You mentioned mixed signals.
Yeah, it's a real mix. Mid-September, you had Jim Cramer saying time to buy, but then Zach's highlighting it dropping more than the market.
Whiplash.
A little bit. There have been analyst upgrades citing things like margin recovery potential. JP Morgan, TD Cowen saw positive signs, but same tariff concerns that hit Deckers apply to Nike too, maybe even more given their scale.
And company-specific news. Some layoffs reported, suggesting cost management, but also exciting stuff like signing Caitlin Clark, new product pushes, and they settled that StockX lawsuit over NFTs. Plus, earnings are coming up around the end of September, and that's a big focus. Analysts seem hopeful for a beat, but remember their last reported quarter, Q4, was weak.
Right, so a lot riding on those upcoming earnings. How does Nike stack up financially compared to Deckers? Obviously much bigger sales.
Huge difference in scale. Sales of $46.4 billion versus Deckers' $5.1 billion. But look at the margins. Nike's gross margin is 42.21%, profit margin 6.94%. Both are lower than Deckers.
Interesting. Less profitable per dollar of sales, despite the size.
Seems that way currently. Returns are decent, ROA 8.6%, ROE 23.3%, ROIC 13.6%, but again, lower than Decker's stellar numbers. And Nike carries more debt relative to equity with a debt-tech ratio of 0.83 compared to Decker's 0.13.
More leverage on Nike's balance sheet then. What about valuation? PE ratio.
Higher than Decker's. Trailing PE is 33.82, forward PE is 29.93. Investors are paying more for each dollar of Nike's earnings, likely banking on that recovery and future growth.
Which leads to growth expectations.
And here's where it gets really interesting. Analysts project a huge rebound in EPS next year, up over 47%. But that's after a really tough current year, with EPS expected to be down sharply. So it's a turnaround story priced in. Sales growth over the past 5 years has been slower, around 4.4%.
So high expectations for a near-term earnings bounce back. Ownership structure.
Institutional ownership is high, 67%, but not as concentrated as Deckers. Insider ownership is much higher, though, nearly 21%. Although, like Deckers, there have been various insider sales reported throughout the year.
Okay, so summing up Nike. Giant scale. Recent struggles impacting margins and current earnings, but holding above its long-term average and with very high expectations for an earnings recovery next year. More complex picture than Deckers.
Definitely. Size brings stability, but also makes it harder to pivot quickly. That projected EPS growth is key. Can they deliver?
All right, third contender. On holding AG ONON. The Swiss running brand Roger Federer is involved.
Right. They've really burst onto the scene. Market cap around $13.9 billion, so much closer in size to Deckers than to Nike. Focus on performance running, outdoor, lifestyle wear.
How did their technicals look? You hinted they were different.
Yeah, quite different, and frankly, pretty rough lately. Looking at the screener, it's negative across almost every recent period. Down over 5% for the week, nearly 3.5% for the month, and down a chunky 18.35% for the quarter.
Ouch. Down over 18% in a quarter where Nike and Deckers were up significantly.
Exactly, and it's down over 22% year-to-date as well. It's also the most volatile of the three, meaning bigger price swings are more common.
Where's the RSI sitting after that kind of drop?
It's getting low. RSI is at 35.74. That's definitely approaching what technical analysts call oversold territory.
Okay, oversold. Does that automatically mean it's a buy? Or more like catching a falling knife?
That is the million-dollar question, isn't it? When a stock is oversold and well off its highs, ONON is about 33% below its 52-week high. Some look at it as a potential buy the dip chance, value opportunity. But the risk is high. The trend is clearly down right now. It's trading below all the key moving averages 20-day, 50-day, and 200-day. That signals a pretty strong downward trend across short, medium, and long terms.
So, potentially cheap, but fighting a strong downtrend. Let's run the paper money math here. $10 K, start of the quarter. This won't be pretty.
No, this illustrates the risk. With the stock down 18.35% for the quarter, if you'd hypothetically invested $10 K at the start, your entry price would have been much higher, around $52.25 per share.
And how many shares for $10?
You've gotten about 191 shares at that price.
And today, with the price down at $42.67.
Those 191 shares are now worth only about $8,166. So that's a hypothetical paper loss of roughly $1,834 for the quarter.
A stark contrast to the hypothetical gains in Deckers and Nike over the same period. So I'll trigger considerations.
Well, the consistent negative performance is one thing. Plus, there was a notable downgrade from Jefferies in August to underperform, specifically citing slowing growth and competition from Nike. For someone holding, that could be a strong signal to consider cutting losses, hypothetically speaking.
Okay, let's look at the news. Jefferies downgraded. Any positive takes?
Oh yeah, still mixed. Bernstein reiterated a buy rating just a couple of weeks after the Jefferies downgrade. Jim Cramer sounded conflicted, called it a favorite company, but also double-minded.
What about their actual results?
They reported Q2 earnings in August. They actually posted a loss, but beat revenue expectations pretty handily. Revenue growth was strong, up 32%, which led them to raise their guidance for the full year.
Interesting. Raising guidance despite the stock performance and tariff concerns.
Yep. The CEO even commented on paying high tariffs on imports from Vietnam, but said they weren't overly worried. And publications like The Motley Fool have been consistently bullish, calling it a potential monster stock for long-term growth.
High growth story, clearly. How do the financials reflect that? Margins.
Their gross margin is actually the highest of the three, over 61%. That's impressive. Shows strong pricing power or efficient production for the product itself.
Right.
But the profit margin is the lowest, only 4.80%. Suggests they're spending a lot on growth marketing, R&D, expansion. Returns, ROA, ROE, ROIC, are also lower than the other two, which is pretty typical for a company in hypergrowth mode, reinvesting heavily back into the business.
Okay, that makes sense. Now, valuation must be high if it's a growth story. What's the PE?
Yeah, hold on to your hat. The trailing PE ratio is 93.49.
Wow, 93. Compared to Nike's 33 and Decker's 18, that's a lot.
It is. It signifies huge expectations baked into the price. Investors are paying a massive premium for future growth. The forward PE is lower, around 28, but still premium. The PEG ratio is also high at 4.63.
What kind of growth are they projecting to justify that?
Massive growth. EPS next year projected to jump almost 92%, by far the highest of the three. And EPS growth over the next 5 years is pegged at over 20% annually. Sales growth over the past 5 years has been phenomenal, nearly 58%.
So the market is betting heavily that they can keep up that incredible growth trajectory.
Ownership.
Institutional ownership is around 58.5%. Insider ownership is the highest of the three, over 31%. Roger Federer and the founders likely hold significant stakes. But again, like the others, there have been numerous proposed insider sales flagged.
Okay, so on holding. Clearly a high growth, high valuation situation, strong recent sales and guidance, huge future expectations, but facing recent market headwinds, technical weakness, and carrying that premium valuation risk. Very different profile.
Exactly. Is the volatile growth play compared to the others. High potential reward, but definitely higher risk, especially in the short term.
So let's try to pull this all together. We've looked at 3 key players in footwear and accessories. Deckers with solid momentum and financials.
Driven by HOKA and UGG.
Nike, the giant, navigating a recovery path with big expectations.
And dealing with the challenges of scale.
And on holding, the high-growth challenger, commanding a premium but facing recent pressure. Quite a range. It really is. It just highlights how diverse this sector is, doesn't it? Even companies selling similar types of products can have vastly different investment profiles, different challenges, different opportunities.
You've got established players versus disruptors, different financial structures, varying levels of brand heat.
Exactly. And underlying themes like potential tariffs, supply chain issues, and shifting consumer tastes seem to be impacting all of them in different ways.
It really drives home why a deep dive like this is so important, right?
Mm-hmm.
You can't just look at one number, like market cap or even recent performance.
Absolutely not. You need to connect the dots. How do the technicals reflect the news sentiment? How does the financial health support the valuation? Is the growth story believable? It's about understanding that interplay.
Okay, so here's a final thought for you, our listener, to chew on. We've seen these different profiles: Decker's financial strength, Nike's recovery potential, ON's growth focus. Looking ahead, say, over the next 12 months in this footwear market, what do you think will be the most critical factor for success?
Is it going to be pure brand innovation who comes up with the next hot shoe?
Or maybe supply chain resilience, who can actually get those shoes made and delivered efficiently, especially if tariffs or disruptions continue?
Or is it about market expansion, successfully pushing into new countries or demographics?
Brand, supply chain, or expansion. Which one will be the key differentiator? Something to ponder as you continue your own learning journey.